primary, secondary, then capital structure. Anything else? Jason, Bradley, Rena, Winston, do you have any key terms to share from your review material, chapter 6?
Systematic and unsystematic risk.
Systematic and unsystematic risk. Right. Systematic and unsystematic. Other keyword, other key terms. Current risk. Good. Any other keywords you can share with us? Okay. Index fund. Index fund.
Share price.
Of course. Share price. Okay. Direct and indirect investment, right? Okay. Now, what is direct investment and what is indirect investment?
Direct is when investor buys and sells shares through a stockbroker.
Okay.
For indirect, it's when investor purchases units in a unit trust or managed fund.
Okay. And then now we have stockbroker here, right? And then say we have a stock market, Australian stock market exchange. Right. And then I said there's so many firms, like Goals, right? Combank. And then we have here investors. Right? Okay. And then direct investment means that you buy the shares from Australian Stock Exchange from stockbroker. Right? So you direct your order to stockbroker to buy, right? And then the stockbroker buy the shares for you, right? And then you pay the stockbroker, and then you got the shares from the stockbroker. Shares, and then this is. Okay, so this is what we call direct investment. It means that you buy shares from stockbroker directly. Right? And then what is indirect investment? Right? What is indirect investment? What did you say before, Sandrina?
Investor purchases units in a unit trust or managed fund.
Okay, so this is what we call the index fund, right? So instead of buying stocks directly to stockbroker, you can buy fund from financial institution, right? Or what we call that mutual fund. So you can buy, this is investors, you can buy mutual fund from financial institutions. So what is the differences between this indirect and this indirect and direct investment? From the asset, from the way that you invest, what kind of similarities and differences between those two? What do you think? Which one is riskier?
I think direct.
This one is riskier. So direct riskier than indirect. Why?
Isn't isn't it in direct investment you have to do due diligence on your own?
Yeah, you can do diligence, right? You can do diligence yourself or by your stockbroker. What do you think? If you buy stocks from stockbroker, what do you expect from your stockbroker? Just providing services for buy and sell, or you expect you have an additional services from stockbroker? None of you invest in stocks.
Not yet.
Not yet. I think you can start small, yeah? Just to have the experience of investing your money into stocks. So you don't market dynamics. So what do you expect from your stockbrokers? You pay fee to stockbrokers, right? And then what do you expect? You get information from the stockbroker,
Or
apart from buying and selling.
like analysis?
Analysis, right? So expect you have like analysis from stockbroker, right? Which shares some you buy, and then which ones you sell, and then which one is better for you to hold or sell or buy more today for particular shares, right? So those kind of services offered by stockbrokers. So I come again to this. So direct investment is riskier than indirect investment. First, because the asset is different, right? So in this kind of direct investment, you buy one or more shares by yourself, right? Based on the information given by the stockbroker. Okay. In this, if you buy index fund, say from financial institution, what you buy is portfolio, right? Okay. You buy portfolio. So say you have index fund on ASX 200, right? So you buy portfolio of Australian Stock Exchange consisting of 200 shares inside your index. So if you do direct investment from stockbroker, perhaps you buy like 3 or 5 shares in your portfolio. Right? So this is riskier than this indirect investment. Okay, right? So the general strategies is active and passive, right? Direct and indirect. So active investors invest, share analysis, information, right? And then passive investor. So if you choose to be passive, then most likely you choose indirect investment strategies, right? Okay. Then, if you invest in these risky assets, you are going to get exposure on these two kind of risk. The first is systematic, and the second one is unsystematic. My question is, which of those risks you can diversify? So you have systematic and unsystematic risk. So which of those risks you can diversify?
What do you mean by diversity?
Yeah, you can minimize the risk. This one.
So less risk.
Yes. Systematic or unsystematic?
Probably unsystematic.
Unsystematic. Again, why unsystematic?
Through portfolio diversification.
What do you mean by portfolio diversification? Just give me a simple example. By diversification.
Match your portfolio based on your needs.
Match portfolio based on risk profile. Okay, and then what do you have to do? Match that. Match by who? By me, by some broker, by anyone else. What? So it is correct that unsystematic risk can be diversified away. And then how can you diversify your unsystematic risk forming portfolio? That is correct. And then how can I form portfolio? Based on what? Based on my risk profile. And then how can you form your portfolio? You buy shares by yourself, one by one, and then what else can you do? So this is an example. So say you have one shares goals, right? And then you also have Woolworths, Woolies, right? And then you have I don't know, Combank, and then you have what other bank in Australia? I think Westpac, right? And then five. I'm not so sure if this is listed or not. You have Myers, right? So this one is groceries, Coles, Woolworths. Combank and Westpac is a commercial bank, and then Myers is retail company in Australia, right? So say you have these five shares in your portfolio, right? Do you think this is a good composition of shares or not? So do you think this is a good composition of investment or not? Or maybe you're more familiar with Indonesian shares or Indonesian company.
Yeah, maybe.
Yeah. So say you have these shares, Telkom, right?
Yes.
Telecommunication, and then again, uh, Astra International, right? And then these shares, Gudang Garam, right? Gudang Garam, and then maybe this is very popular for you, Unilever, right? And then Indofood, right? So do you think this is a good composition of portfolio? Yes, why? And why?
It's like in different sectors.
Yeah, this is different sector, right? This is telecommunication, and then Astra International is conglomeration of automobile and investment. Gudang Garam is, yeah, you know Gudang Garam, right? Now includes the investment company. and then Unilever, which is very popular, consumer goods, right? Indo food, yeah, food and beverages, right? So this is kind of a portfolio that is pretty good for you because you have diversification, right? Diversification means you invest in in more than one industry classification. Right? Say now if you invest only in Bank BRI, say, and then the second one is Bank Mandiri, right? So you invest all of your money in one industry. In comparison, you invest your money in different industries. It means that you don't do diversification in these investment strategy. Right? So forming a portfolio is doing diversification means you invest your money in more than one industry. Why? Now, why do you have to do so?
Because if one industry like fails, you have other backup.
Yeah, because there are many different cycles of industries, right? Consumer good industries has different cycles with bank industries or financial institution industries, and then also different with consumer goods industries, right? So in terms of crisis, which industries is best to invest?
Crisis?
Crisis,
What kind of crisis?
yeah. Economic crisis, not moral crisis. No, we cannot measure moral crisis, right? Economic crisis. During economic crisis, which industry do you think the best to invest?
Economic
Yeah, what kind of economic crisis?
Yeah, economic crisis in general, financial crisis, right?
crisis? Food?
In terms of financial crisis, health industry like COVID-19. Yeah, you're right. And then
Yeah.
COVID-19, health industries.
Property? No, property di cancel.
Properties, do you think it is sensible to invest in properties during crisis?
No.
No.
Gold.
Because this is very risky investment, right? Properties is one among the highest. Gold. No, we are talking about share market. Right? What kind of industries do you think the best to invest in during crisis? Health industries during health crisis, COVID-19, right? And then what kind of
Yeah.
other industries do you think is sensible to invest in? Do you know any financial crisis? No? Global financial crisis? Yeah, right. You know about global financial crisis, right? I don't think you experienced the crisis, but at least you know those kind of crises. In those kind of crises, what kind of industry do you think the best to invest in? Right? What kind of industry do you think the best to invest in? Insurance. Do you think we still need to eat during crisis?
Yes.
We need to eat, right? And then, yes, consumer good is one of the best industries you invest in during crisis.
Staple
Yeah.
goods especially.
Excuse me?
Staple goods especially.
Stable goods, yes. Like Indo food is one of the best investment during crisis, right? Consumer goods, Indo food, Unilever, right? So this is kind of industry you are going to invest during crisis. Okay. What kind of industry again? You are going to
Medicine.
invest? Sorry,
Medicine.
medicine. Yeah, health industry. Right. And then, what is the best investment you are going to do during like very good growth of economy?
Technology?
Yeah.
Technology, right? Yeah, technology, like then
Luxury goods.
luxury goods, Louis Vuitton. Any other industry to think of?
Yeah, real estate.
Real estate, yes, real estate. What do you think about banking and financial institutions during economic growth? Would that be a good investment? Right? So during the economic growth, you need a lot of money to grow, right? Like technology industry, luxury goods, and real estate industry, you need so much money to grow your business. So one source of financing for this kind of industry is financial institutions and banking, right? Okay, so that those kind of strategy uh, you can apply to your portfolio, right? Diversification, following your risk profile, of course, and then familiarity in the industry. So if you are really familiar with consumer goods, then you can invest in consumer goods. If you are not really familiar with consumer goods, but you are familiar with other industry, then invest your money in the industry that you are familiar with, right? Okay.
So currently, are we in a good financial state, like in America?
I think most of us said that we are in the mixed condition of economy, but I'm still, for me, still optimistic looking at Indonesian growth now.
So, what kind of industry should we invest in, like in this kind of?
This kind of economy, banking sector would be good, and then consumer goods, right? If you have a look at the index in Indonesia, growing for 7,300 to 7,800 now for the last 3 months. I think the economy is still good now. I'm not so sure about after October 20th, after the inauguration of new president. I think this is a good time for you to invest. Okay. Any other questions? So if not, so this is what we are going to discuss about the systematic and unsystematic risk, right? So we have beta there. So what is beta? Beta. What is beta? What is beta? Right?
Wih, beneran. Tapi D-nya
This is an example of Australian company, JB Hi-Fi, has beta 1.20, and then other company Telstra, telecommunication company, the beta is 0.95, and then ANZ Bank beta 1.05. So, what do you think about beta? What is beta? What is beta? So, from these three companies, which company is the riskiest? Telstra. Why is Telstra is the riskiest? Telstra is riskiest. Which one of these companies is riskiest? Do you know any idea what this? Did you learn about linear regression in high school or linear equation?
No.
Linear equation y equals a plus bx. You still remember that?
You're giving me PTSD.
Yeah.
No.
Did you learn this? Y equals a plus bx. Right? Linear equation. And then you plot this line, I don't know, like this. Which one is A? Which one is B? Is this A or B? B. Right. B. A?
Yeah, the other.
Horizontal.
This is X, this is Y, right? This one is B, this one is A.
The line is with this.
Then you forgot everything about this, right?
So you
Actually,
can't
this is
hurt
about the
somebody.
linear equation.
You're making my head hurt, sir.
Okay. I'll rewrite this linear equation with this. So this is the return of a security equals with risk-free rates, right? Plus beta. So this is beta. And this is the return of the market, excess return of market over risk-free rates. So risk-free rates is practically, if you check Australia, they have like Federal Reserve or Federal Reserve of Australia rate, right? So this is the base rate, right? So this is the excess return of market over risk-free rate. Okay. So this is beta, right? Beta. Beta is sensitivity of return of risky assets to the movement of market. Right? So if the beta equals 1, then this security moves similarly with the market. Right? So if beta equals 1, then if market moves 1 point, then the shares on the stocks here moves also 1 point. Positive, right? Positive. Right? If market moves down 1 point minus, then this stock also moves 1 point. Right? So forget about this formulation. Let's focus on the definition of beta. Right? So if I put beta equals 2, then if the market moves 2 points, 1 point, I mean, market moves 1 point, your stock will move 2 points up, right? 2, beta equals 2. And if the market goes down 1 point, your stock would go down 2 points.
Hold on.
Okay? So beta is sensitivity of a stock to the market. Okay? If the beta equals 1, right? If the market moves 1 point, then the stock would move 1 point, right? Up, right? If market goes down 1 point, then the stock here will go down 1 point. So it equals 1, right? If the beta equals 2, if the market moves 1 point, your stock would move 2 points.
Oh,
Right?
betanya
2 points.
Karena 2 kali 1.
No, it's not about it's sensitivity. This is sensitivity, right? But if the market now goes down 1 point, your stock would go down 2 points
because the beta is betul.
because the beta is 2, right?
Berarti kalau ini betanya apa itu berarti naiknya
Right? Again, which one is the riskiest among those three? Which one is the riskiest among those three?
High five.
Berarti semakin
Yes.
turun beta.
Right?
The higher
Yeah.
the beta, the riskier.
Yes, you're correct. The higher the beta, the riskier the stocks, right? Okay. So the higher the beta, the more aggressive the stocks. Right. So again, during not so good economic growth of all these three stocks, which one do you choose? Telstra. Why Telstra?
Because it's the least beta.
Yeah, because the sensitivity to the market is the least sensitive among these three, right?
I like him.
You like what?
He likes going broke.
You like something. You like going broke, then you invest in JB Hi-Fi. Okay, so beta is the sensitivity of a stock to the market, right? And then, yeah, I already, what is portfolio beta? This is the, right? Sorry. Okay, so beta is the amount of systematic risk, right? So if we are talking about systematic risk and unsystematic risk, then beta is the systematic risk. So systematic risk cannot be diversified away. So you cannot diversify systematic risk because this is market risk. What happens in the market, you cannot diversify. Right? You can diversify unsystematic risk by forming a portfolio with different industry. Okay? Right? Do you have any questions on beta, systematic risk, and unsystematic risk so far? More clear? The definition of beta. So beta is systematic risk, right? The higher the beta, the riskier the stocks, or more aggressive the stocks.
but it will generate more return.
Generate more? Yes. If you choose higher beta, then most likely in the market, if the market moves, you can get potentially higher return than lower. Right?
Sorry, what is the RM stands for?
ORM is the market return. This is the market, right? So this is market return, this is stock return. Right? Yeah, this is stock return, this is market return. RF is risk-free range. Fed fund rate or central bank rate. Usually we use central bank rate. Okay. Now, what is the portfolio beta then? So I come back to this. So you have three betas, and then you decided to buy these three stocks. What is your beta then, based on these three stocks? How do you calculate the beta of your portfolio?
It's very
of your portfolio. So you have these three stocks in your portfolio, right? Each stock has its own beta, and then now you want to have beta for your portfolio. So how do you calculate the beta for your portfolio? RI stock return. So we have three betas, and then you have investment values 6,500, 8,600, and 7,900. And then you want to estimate your portfolio beta.
If you buy all three,
Excuse me?
is that like your portfolio? Buy all three companies.
Yeah, but all of these three stocks, right? So you invest in these three stocks. You have three betas for each stocks, and then you want to estimate your portfolio beta of these three stocks. How can you get to estimate the beta of your portfolio? Any idea?
Beta divided by 3.
Beta. So the average beta of three stocks.
Yes.
Yeah, that makes sense if you have same value for each stock. So say you have 6,500 JB Hi-Fi, 6,500 Telstra, 6,500 ASN Bank, right? So you just divided this beta by 3. So you invest the same value for three stocks. Now you have different values for these three stocks. Then how do you calculate your portfolio beta?
The beta of each stock is multiplied by the proportional value in the portfolio, and then all of it are summed.
Yeah. So what do you call those kind of calculation?
System.
Yeah, that makes sense if you have same value for all of the stocks in your portfolio, then just divide it by beta. That's the easiest way to do that.
Multiplied by the proportional value in the
You familiar with value weighted? Value weighted. Right? Value weighted. How do you do value weighted then? What is the weight for JB Hi-Fi then? How can you calculate the weight of JB Hi-Fi?
weight of what?
JB Hi-Fi in your portfolio.
Or its market value over the cost of overall performance.
Yeah, all right. Right. So its market value 6,500 divided by total of your investment. Right. So let me. This is the value weightage. This is one example. JP Hi-Fi, Telstra, and INZ, right? Say this is the scenario one. So you invest $3,000 to this stock. Thousand, right? Thousand. Okay. And then you have beta, right? 1.20, 0.95, right? 1.05, right? So if you want to check your beta with this same value, easy, like Bradley said before. You just get the average of this beta, right? Now in scenario two, you don't have the same value for all of those three stocks, right? 6,500 and then 8,600, right? And then 7, right? So this is going to be sigma, I would say sigma x, right? Total of this, right? And then the weight of JB hi-fi would be 6 divided by 6, right? So this is how you get the portfolio beta. Right? And then this is 8,000 divided by sigma x, 7,900 divided by sigma x, right? And then say this is A, this is B, this is C. Then your portfolio beta portfolio would be A times 1.20 plus B 0.95 plus C times 1, right? This is what we call value weighted beta. Yeah.
So it's different from portfolio beta.
That's the same. Portfolio beta, value weighted beta. It's the same, right?
And
Or weighted average beta. It's the same. Okay. So this is the weighted average beta, 1.05. So what is your conclusion from this table? By combining these three stocks,
it's risky. Well,
yeah, it's risky, right?
yeah, it's about one.
Okay. Now you can check the value of JB beta 1.20, right? And then Telstra 0.95. So say if you put all of your money to JB, then the risk is quite high, right? Of course, with high return, high risk, your return would be also high potentially, right? And then say if you invest all of your money to Telstra 0.95, right? This is not so high risk in comparison with JB Hi-Fi. Right? So you are going to lose the opportunity to have higher return. If you invest your money all to Telstra, in comparison if you invest all your money to JB Hi-Fi. Right? Then you come up with the idea, what if I mix all of these three together into one portfolio, right? And then we can calculate the weighted average beta, and then the weighted average beta is 1.0549. Okay, right? So you can reduce your risk by doing diversification, right? So if the weighted average beta is higher than 1.20, then there is no point of diversification. Say you have weighted average beta of 1.5, then there is no point of diversification using these three stocks in your portfolio. Right? So the diversification means that you can reduce the highest risk in your portfolio by forming or by choosing, right, stocks from different industry. So this is an example of diversification. Okay. Do you have any questions on this topic? Okay. Clear? Okay. Now I'm going to add a little bit complexities in our portfolio. Now the investor add to the portfolio AGL Energy with beta 1.6, right? So what is the impact of this investment to overall portfolio? Do you need to check or do you need to have a look at the value and beta? And then the AGL value 5,000 with beta of 1.6, right? AGL 5,000 beta 1.6. Yes. So is it higher than 1.05 or lower than 1.05?
Here.
Higher.
Higher than 1.05. What is the value?
1.4.
Okay, right. So if we add Meyer or AGL into our portfolio, $5,000 with beta 1.6, right? And then you calculate your weighted average beta. Weighted average beta is 1.15. Well, if you compare with previous portfolio, 1.05, which one do you prefer? 1.05 or 1.15? So, how many of you 1.05? 1, 2, 3, 4, 5, right? 1.05, 5, 1.15, the rest of you, right? 7 of you, right? So most of you love risky portfolio, 1.15. Is it okay? Yeah, that's fine, no problem. It's a matter of preferences, right? If you want to diversify your portfolio, then it depends on your preferences, right? Okay, again, if you check again, the beta of Myers is 1.6, and then the beta of JB 1.2, and then the combination of these four stocks end up with 1.15. Again, this is an example of diversification, right? Okay, do you have any more questions on this topic? All good? Clear?
Walaupun dia above 1, but it doesn't mean that it's bad if
Yeah.
it's risky, but it also gives higher the one.
Yeah, just yeah.
What's the maximum before it turns into bad?
Well, it depends on our risk preference. If we really love risk, then the higher the beta, the better for us. Right? So you chase higher beta to get more return, potential return, right? Not realized return. So if you say, well, I think I'm not really into stocks that has or have beta around 1, then I'm going to sell Telstra and ANZ, and then I'm going to concentrate only on JB and Meyer 1.2 and 1.6. That's fine, right? As long as it is matched with your risk preferences. But if you feel that 1.2 is just too high for you, then you decide to sell JB and Meyer and then keep Telstra and ANZ just to keep your portfolio move similarly with the market around 1, then that is also fine, right? So there is no wrong and there is no right in this portfolio formation. Okay? So in doing stock investment, the first thing that you have to understand is there is a risk, right? So how do you calculate risk? I believe that you already learned statistics. You still remember average or mean and then standard deviation, right? So and then variance, right? Variance. So the easiest way to estimate or calculate risk of a stocks is to estimate its standard deviation of return. So if you have the standard deviation of return of stocks, then you can estimate the risk. So the higher the standard deviation of stocks, the higher the risk. The higher the standard deviation of stocks, the higher the risk. Right? So risk you can estimate with variance, right? And then you can standard deviation. Right. The other estimate for risk, what we call is beta, right? Beta is relative risk of a stock to the market. The investment principles is high risk, high return, right? So if you get more risk, then expect to get more return. Now, if you put your money in a bank, right? First one is bank, and then the second one is mutual fund. The third one is direct investment, shares, right? So which one do you think of these three has the highest risk? Highest risk. Invest in a bank, put your money in the bank, and then invest in mutual fund, or you do direct investment in shares. Right? This is the highest risk possible you can get from your money. So you expect highest return on this investment. Right? Say if you invest your money in a bank, I'm not so sure now what is the interest rate, like 5 or 4%. I would put 4%, right? And then you invest your money in shares, then you get like 4%. Yeah. Then there is something wrong with your investment managers. Move to another stockbroker, right? So you have to get like more than 4%. Okay. So okay. Now, what kind of stockbrokers do you know from your review? We already discussed one kind of stockbrokers earlier. The stockbrokers provide you with the information, analysis, recommendation for buy, sell, or hold. Do you know another kind of stockbrokers? Yes. Do you know Robin Hood?
Batman's friend.
Batman's
No.
friend. Robin Hood is Batman's best friend. Robin Hood is one very popular application for stockbrokers, right? For stockbroking, for buying and selling stocks with very low fee. So we call this kind of Robinhood is wholesale stockbrokers, right? So wholesale stockbrokers do not provide you with any information or analysis, right, or recommendation of stocks. You better to be buy, sell, or hold. So they just execute your order. So say now you, I don't know, do you know Ajaib investment application in Indonesia? What's in India? What kind of popular application in India for investment? Zero, zero dark. So those kind of application is practically a wholesale stockbrokers. So you cannot expect that this kind of application give you more information than doing your transaction. That's why the transaction fee is very low. Right? They do not offer service other than executing your transaction. Okay. Okay. And this is, I think, one of the how can we get a fair price, right? So after we are talking about the risk, now how can we get a the right price or the fair price to buy a stock? So this is the way we can evaluate or evaluate the stock price. So this is a very short case. Last dividend paid to shareholders by vicinity centers was 0.10, right? Board of Directors plans to maintain constant dividend growth policy, 7%, right? Then evaluating investment, 12% rate of return. So this is the risk profile of the investors. The current price of vicinity shares in the stock market is 4. And then should the investor purchase the share? How do you calculate the fair price? And then how can you help this investor to this? So try to calculate the fair price. The idea is similar to calculate the present value. So remember present value and future value. So this is pretty similar with present value calculation.
些之前有些比如说我们这个小市场，现在只有只有我们从一下有对那个数据来。
Please let me know if you come up with any idea of how to calculate the fair price.
Ini konsumsi
Jadi 1+7% impor sama
R12
required rate itu
12.
ini 12% dikurangi 7%. Dikali sama sama satu.
Itu kita cari ini. Dari water baseline. PO-nya kan share price itu kan yang
Itu
ada
dari
di
mana?
itu.
Tapi enggak sih terus. Kalau konsumsi 8.
12% dari
Nah, terus itu kelas dividennya berapa?
Itu nanti anu nggak sih
Dibandingin.
iya dibandingin sama yang expected dividend.
Yes.
Tapi aku sebenarnya 2,5.
2,1.
So what is your calculation?
Nggak tahu ya. Kalau mau
Iya betul. Di mana 20? Share price. Bilangnya 40.
So who gets around 2?
Ya, 2.5.
Yeah.
oh itu Neta
2.5 is not around 2. Around 2 means 2.1, 2.3, 2.4 is around 2.
Gimana caranya sih? Kita nyari final word. Iya ya, apa namanya tuh?
harus
Nah ini
empat tahun baru bisa rate of return 12%.
Right.
Share price-nya kan?
So the first one, you have information of last dividend paid, right? So the last dividend paid is 0.10, right?
Yes.
So what is the future value of last dividend paid with 7% growth?
0.1%.
Yeah, right. Times 1 plus
0.
0%, right?
Yes.
Then this is P0. And then we have the future value of dividend with 7% growth infinitely, right? And then what we need to do is to discount this value with certain value to get current prices or current price, right? So we need to divide by what?
12% minus
What is 12%?
0.12.
I'm sorry, what is 12%? Is that your risk preferences or required rate of return?
Required.
required rate of return, right? So 12% is required rate of return minus expected growth, right? So this is going to be 1 point, right? So the current market price is 4, right? The fair price is 2. So should you buy or not?
No.
No, right? So don't buy the stocks. This is overpriced stocks, so don't buy. Okay, so we can. This is the value of stock, right? This is the market price, right? So if the market price is higher than the value, then this is the overvalued stocks. So don't buy, right? So with different scenario, if the current market price is 0.5, right? And then you have value of 2.14. So this is the market price, the value of 2.14. Then there is a possibility that this price of stock would increase to 2.14. But in this case, the market price already overvalued. It is higher than the value, so don't buy this. Right? So what happens if you lower your required of return? Is there any chance that this value would match the 4, lower than 4, or higher than 4?
Yes.
Yeah, there would be a chance. There is an opportunity, there would be a chance. And then what if I change this dividend become 0.5 and then I lower this required of return become like 8? What is the implication of your decision? Any chance that you can buy this stock or any chance that you shall buy this stock?
Yes.
Yes, of course. So by changing those variables, the dividend and then the required rate of return, yeah, you can change your decision from not to buy to buy the stocks. I think one more questions and then we can break, and then after the break we can do the presentations. One more questions. From all of these variables, which one you can control? You have your own control. Yes, required rate of return is the one that you can control, right? Now you define your required rate of return is 12%. But I think with this kind of required rate of return is too high. Then I can lower my required rate of return from 12 to 10 or 12 to 7.5 or 12 to 8, right? So these variables is depend on our risk profile. Okay. Okay. Let's have a short break. 5 or 10 minutes. 10.
That was instant.
7.5.